Well, welcome to another exciting episode of the Trading Bell. I would tell you this one, we're looking right into the future. It's all about the derivatives. And my guest has come all the way from South Africa today. Her name is Bronwyn Williams, and she is a trend translator and future finance specialist. So before we get right into what that is all about, take a look at her profile.
Bronwyn Williams is a trend translator and future finance specialist for Flux Trends. Bronwyn has over a decade's experience in marketing management and trend research, working predominantly with brands in the financial and business-to-business industries. Since 2011, Bronwyn has collaborated with Flux Trends on a number of projects, lending her research and writing skills to the Flux Trend reports and presentations, including the fragmented future of finance, virtual money, so you want to hire a millennial, digital burnout, from bricks to clicks, and Generation Z, the real game changing generation. In addition, she ghost-wrote Dion Chang's The New Urban Tribes of South Africa book, published by Pan Macmillan. Prior to collaborating with Flux Trends, Bronwyn worked as the publisher at the South African office of the Agora Group, one of the world's largest independent financial publishing houses, headed up by the international New York Times best-selling author Bill Bonner. In this role, Bronwyn managed the largest circulation South African financial newsletters and worked closely with a network of local and international financial thought leaders, giving her access to a wealth of insider insights on how the world of money really works.
Thank you so much, Bronwyn, for joining us today in Nairobi, and I'm hoping you've had a good trip.
I have. It's been wonderful to get to know your country a bit better.
Amazing. Let's get right into what you do. A trend translator, future finance specialist. So initially I was also told you're a futurist. So I thought, do you hold a crystal ball to see all the finance figures and where they're going to go? So what really does it entail doing what you do?
I wish I could predict the future, then we could all be very, very rich. That's not the way it works. What my job entails is I look at the current trends and how they are likely to impact us on the future. In particular, I look at the intersection of consumer trends and technological trends overlaid with economic trends to try and then translate them, hence the translator part of my title, into actionable business strategy for the clients and institutions that I work for.
Okay, amazing. So I believe that one of the areas that you're very well versed in is derivatives and the futures market.
Yes, the future of futures, right?
Even better, almost a moment where we're going even deeper. But derivatives market, of course, the NSE recently launched Next, and that is our derivatives market. But where you come from, South Africa, of course, they've had it for so long, from the 90s. And what are some of those regulations, those rules that really need to be into place for such a market to function at its optimum?
Well, I think the first thing to realize about derivatives is they are riskier instruments. They're more powerful. That's not to say they're bad. It just means that everything you do with derivatives is magnified. So if you make a mistake, you can lose a lot more money. Now, the other thing to realize is that derivatives can be traded without regulation, without exchanges too. And consumers are quite seduced by those, especially when you've got institutions going around offering get-rich-quick schemes and, invest in this and make a lot of money overnight. So it's very important that there are regulations in place to protect investors that might not have the financial literacy that is required to trade safely in these markets. Now, when you're trading through an exchange, it's a mark of security. It's a mark that says that this investment has been vetted by both sides. There's adequate counterparty risk, there's adequate liquidity in underlying investment, and that's why it's very important that these sort of things are regulated, because they can be done without an exchange, but they're much better done with an exchange.
Absolutely. So if we were to really just break down derivatives for somebody who doesn't understand them, how would you define them in the simplest way?
Okay, derivative is basically, I'd hate to use the analogy, but it's the easiest way to understand it. It's like taking a bet on the performance of an underlying asset. Another way to look at it would be like what happens when you buy a house and you put down a deposit. So you put down a deposit, you borrow the rest from the bank, but if you sell that house and that house goes up in value by the time you've sold it, you still only owe the bank the initial loan amount. You don't owe the bank for the profit that you've made on that house. Okay. As such, you get to make a magnified return. So if that house goes up 10% in value and you borrowed 90%, and then instead of making 10% on your investment, you actually make 100%. So that's what derivatives do for you. They give you the power to magnify your gains, or conversely, just to be honest, your losses too.
So it's almost like a buffer.
Yes, exactly. So it's like you put down a small amount, but you get the full amount of the underlying value.
Great. So who then would you say is the ideal investor for futures?
I would say that there are many applications for futures. A lot of people think of it automatically in terms of institutional investors and wanting to invest in an emerging market that tends to be a bit more volatile, like the Kenyan market. So if you're a big institutional investor and you've got pounds or dollars to invest on behalf of your clients, it makes it a much more attractive proposition if you're able to then hedge those investments against a downturn or volatility within the underlying market or currency that you're investing in. But at the same time, I wouldn't say we should discount individual institutional investors, because trading and that ability to make outsized gains from a small amount of initial margin opens up the potential for a whole lot of new careers and employment opportunities for people to actually become self-employed traders, assuming of course that they have the correct financial literacy and they understand the risks and rewards and the strategies required in order to capitalize on those markets.
Okay, interesting. So when it comes to the sort of significance that Kenya has in becoming the second Sub-Saharan African country to actually have this sort of trading after South Africa, do you predict which country is going to be the next? Have you seen already indications from any other African countries to be the third to have derivatives on their portfolio?
I'm sure Ghana and Nigeria would both be looking at this very seriously right now. They both have quite advanced markets and enough capital flowing through the system to make this a viable opportunity. I'm sure they're quite jealous of Kenya right now.
Great. But when it comes to how this affects the entire ecosystem within, let's say, East Africa specifically, of the kind of bolstering or the deepening of the markets here, we always have investors coming from outside, which does provide great incentive as well. But then the problem is that there's so many macroeconomic factors affecting their decisions. So to get even more local investors on board, what do you think the East African exchanges need to do in order to boost that?
The regional investment within the sector. I think it definitely comes down to financial education again and financial literacy. People can't invest in what they don't know, and they shouldn't invest in what they don't understand. But there are very much opportunities that come on board with things like futures for people to actually start investing with less money. So when you're buying an equity, you have to put up the full cash amount. And also your fees tend to be a bit higher because of the way exchanges work and the way the fixed fees work on those instruments. With single stock futures, like what is being offered here now with the next exchange, you're able to trade for much lower fees, which makes it more viable to someone that might have a smaller amount of money to start trading in the marketplace.
Okay.
And this will become even richer when you start getting the private sector involved with building platforms to make that accessible to the market. Like there are platforms in South Africa right now where you can invest using derivatives in the actual Johannesburg Stock Exchange, starting from just R1, or that would be the equivalent of like 10 shillings.
Wow.
So that's amazing. It means that a child can start trading on the markets even when they're still at school. In fact, I know a story of a young boy who bought R1's worth of every single share on the Johannesburg Stock Exchange, and he was able to do that because of the way futures work.
That's amazing.
It really is.
Wow. Can't imagine the returns from that after that point.
Well, if you buy everything on the market, you're not likely to make that much of a return, right?
Yes. But specifically talking about South Africa, I think you recently also developed your financial market with the currency futures market. So how do you get to that point? Because I understand also initially that when the Kenyan NSE had the idea to do that as well in the beginning, that was not something that was very possible at that point. So of course you've got to that point after many, many years. How does that work?
Okay, so currency exchange would be Forex, and Forex has become a very popular instrument for people to trade, particularly retail investors that are trading on the stock exchange. Retail investors love to trade Forex because it is liquid, which means you can make large or small trades at will, and it tends to be very volatile, which means your opportunities for speculative trading and gains are much higher on those markets than on a slow-moving blue chip stock that might not have that many movements. That's the attraction to professional traders. Now, of course, because of that, it does tend to be a bit more risky as well, and then you've got the additional issues that you're basically betting against your own currency, which is not always something that the governments and regulators and central banks feel entirely comfortable with. But that said, the Forex market is probably one of the fastest growing derivative markets in the world and has some of the biggest and largest trades going on. And it's something that you can't really stop, because even if your exchange doesn't offer it, there are other exchanges that offer it. So for example, right now you can trade the Kenyan shilling if you want to,
Yes.
using other exchanges around the world. So that's the question that regulators and banks need to ask. Are you comfortable with someone else writing the rules, or would you much rather have at least some degree of control as to how those instruments are traded on your own currencies?
Amazing. And I do know, aside from that, that you have also written so many trend reports, especially when it comes to Gen Z, millennials, digitization as well. And what sorts of incentives or what sort of specific education do such a group of youth need for them to get even more interested in trading?
I think the first thing, if you want to connect with the young market and getting them involved with systems like this, is to make it easy to do so. You've got to remember, young people have grown up with the internet. They're used to getting what they want, when they want it, on demand at the click of a button from their phone, whether that's transport or whether that's online deliveries, whatever it is, it's got to be easy. So you have to tap into that easy one-click online environment. So you want to make the registration process for opening a trading account really easy. So there's banks in South Africa, you can open a trading account using your selfie because they've got your data from your facial recognition tied up to your identity. So you want to look at things like that that reduce that barrier to entry. You also want to look at making it a low-cost offer. That's not to say that you're not making a profit of these exchanges, but just like I was saying before, making it accessible to start investing with a small amount of money. So instead of having to put in thousands and thousands of shillings in order to just get started in the market, make it accessible so that you can start with just a small amount. And brokers need to be comfortable with that, and your trading intermediaries need to see the opportunity, because if you can get someone involved with trading when they're young and they don't have much money and they're basically just trading with their pocket money or their student job income, then they're going to become much more sophisticated investors later on in life, and that they need to see the long game then.
Absolutely, very interesting. But away from just the conversation on derivatives, when we talk a little bit about the kind of trajectory that Africa is seeing with the development of our economies, how are you seeing 2019 faring so far?
Well, I think that Africa is one of the more exciting places to put your money right now. And once again, as a South African, I'm quite jealous of the Kenyan growth right now. We've obviously not had such a great time with our economy lately, but the Kenyan growth at over 6% is really an exciting proposition for external investors. The world at the moment is looking at an average of 3% growth, for example. Europe and America, most of those countries are under 2% growth. So Kenya is very primarily positioned to take advantage of that, particularly now with these derivative offers, in that you're able to balance that potential for growth with a way to hedge against or insure against volatile currency movements and commodity movements below that.
Okay, and also when it comes to trends, one of those that we've seen emerge again and again is cryptocurrency. How do you think that in Africa that is being handled? Because there are a lot of people who look at it very skeptically, and there are those who are in it 100%. But what is the development of cryptocurrency and its trading so far that you've seen picking up in different areas?
So I can speak to the South African market in particular. South Africa, I think, has the most amount of cryptocurrency wallets open, proportional to the population in the world. So we're quite an advanced cryptocurrency market. And I think this comes from the fact that we've had a derivatives market for some time, and the trading, in particular Forex trading, is something that's not unfamiliar to South African consumers. So if you can trade Forex, it's not such a big jump to then start trading cryptocurrencies as well.
Yeah.
So we're quite advanced in that, understanding the way these things work. Now, they obviously have implications for real currencies too, because these cryptocurrencies are getting to the point where they are trading quite large amounts of volume. In fact,
Absolutely.
the market cap on cryptocurrencies right now is as large as the economy of France. So there really is a lot of money moving through it. And of course, the latest trend to emerge from there is Facebook's own cryptocurrency, which is almost a hybrid between a cryptocurrency and a real currency, in that it is backed by a basket of real fiat currencies, which Facebook will actually be buying and holding for every one of its tokens that it offers through the Libra system.
Okay. So intriguing, that is, definitely. So thank you so much for speaking to us, for giving us so many insights as well, and for, of course, getting right into the conversation on the trading bell.
Thank you very much.
All right, on that note, we'll be right back with the market analysis.
Thank you so much, Maalika. It's now time for market analysis as we take a look at how the markets closed this week. And I'm joined by Samuel Gishohi, who is from NIC Securities. Many thanks for having you on the program this day.
Thanks for having me.
Well, Sam, looking at the markets, you're seeing a very peculiar development, especially around when you look at the big gainers. You don't see the stocks you'd anticipate to see. And of course, you're seeing, for example, when you look at the market turnover, this week it has been at 738 million as the week comes to near close. What do you make of this, Sam?
We've actually seen quite a drop in turnover, and I think this is because locally there's a bit of a liquidity crunch. Of course, there's little access to credit. There's a lot of focus. Of course, we're just coming from the tax, issues, and so there's no money in the market. So local investors are not really trading. Most of the trading we are seeing right now is foreign. Actually, sometimes more than the 75%.
Sure.
And so clearly, you're going to see that there's a lot of activity on Safaricom, KCB, Equity, Barclays, for example. Today, we also saw HFCK on that list. But when you look at the gainers and the losers, you find that there are some very small companies that are actually doing anything on the market, or doing big moves, price movements on the market, which means that there was local activity on those because they are very low liquidity. And sometimes big returns or big changes in the price are a function of low liquidity.
Sure.
So I think the market right now is at a level of stagnation. We've seen the indexes are not losing much or gaining much, but sort of staying stagnant at a certain level.
So should investors be worried about this?
Not particularly worried, but I think the economy needs to pick up so that people have disposable income. The local investor will not be able to invest in the market until they have disposable income. And as long as we have a liquidity issue where people don't have credit, they cannot invest. People need to invest for them to make the money that now is disposable income that they bring back to the market. It's not happening right now. We are seeing a lot of investors, struggling with liquidity, which then means the market remains quite slow.
All right. Of course, what you're saying is quite a testament to what's happening in the economy. There's that tussle between the counties and the national government over the revenue bill. And of course, it's yet to be fully concluded. But let's shift gears a bit, Sam. Looking at the bond market, it's at about 4 billion worth of bonds traded. We did see an improvement 2 days ago, which was at about 5.6 billion. And as the week is drawing to an end, of course, there's a lot of expectations now that we're seeing the Emma Kiba. We're also seeing banks putting in money in long-term securities.
Well, that phenomenon is called flight of capital. If the stock market is not performing well, then money moves from the securities market, which is higher risk, to the bonds market, which is lower risk but has consistent returns. Of course, the problem that some investors find in that is that right now the yields on the bonds market can be a bit low because, of course, since the capping of interest rates, we sort of have seen the yields on bonds becoming quite insignificant, quite low, basically, very close to the level of inflation, meaning it's not very attractive. But still, for safety, then anyone looking at the market and thinking nothing's really happening there, they will probably want to go to the bonds market. So we can see that happening. Banks, of course, if they're not lending to the public, then chances are again lending to the government, and the government has an appetite for the funds. So then again, that creates movement to the bonds market. However, I still think that this is the time to be looking at the equities market. Reason being, it's low. There's not much. When others are afraid, be brave. That was Warren Buffett, I think. So I think this would be a good time to start looking and saying, pick up those low-lying fruits, because the moment the economy, and it will eventually pick up, once the government starts paying, which they have started doing actually, once the county funds are released and money starts flowing down, trickling down, then we're going to see some disposable income, and chances are we'll see more coming into the equities.
Interesting.
Yes.
And Sam, as we come to the tail end of analysis for today, we're seeing some very interesting moves, especially on the top losers. This week I'm seeing Kenya Airways. This is a very critical stock for many Kenyans, not only the elite investors, but even to the economy in terms of the airline's direction, in terms of where it's headed to. We've seen KQ indicating that they are slowly but surely coming out of the turbulence, and they've been trying to minimize their losses, but not yet out of the woods.
Well, minimizing losses is one thing, but losses are losses. So investors react to the bottom line. Because if you're making losses consistently, then investors are going to shy away from you, because then it's risky.
Yeah.
You know, they don't know how much loss you'll make the next time if you keep making losses. We've seen it happen, and unfortunately, it tends to happen to a lot of the more, I don't know, government-associated, companies. Mumias, I think, has the same problem. They've been closed for I don't know how long. I don't know when you last saw a packet of Mumias on the shelves. So
It's been
again,
a while.
Absolutely. So airlines are usually affected by a lot of external factors, very unpredictable. Because today it will be oil prices, fuel prices for that matter, because then if fuel prices are too high or they go up, then Kenya Airways has an issue.
All right.
If there is a travel advisory, Kenya Airways has an issue, because then people don't want to travel. So there's always something external that is affecting them.
All
and
right.
I think that's the difficulty.
Interesting. Let's talk a bit about how the shilling has been performing. We've seen the shilling shedding off against the greenback, now standing at about 103. And of course, this has led to some relative speculation, especially in the forex market.
There has been a bit of a mismatch in the valuation of the dollar, and this debate started like a year or sometime back.
Yeah.
That the dollar has held up against the dollar, the shilling has held up against the dollar vis-a-vis other currencies across the globe, because the dollar has been strengthening over other currencies and the shilling staying there. And this was mostly attributed to the government protecting the dollar. I think at some point the shilling would devalue, was going to start at least devaluing towards where it should be. I don't want to point a particular figure, I haven't done the research, but we have had some houses saying that the shilling right now is
overvalued.
Yes.
Which CBK says is
well, CBK will not
far-fetched.
accept. Well, they have been trying to protect the shilling anyway. So if they feel they have the power to do that, then they're right. It's far-fetched to them. It depends on how much or how long they can actually be able to keep the shilling stable.
So by the shilling, of course, ceding to the dollar, what does this mean, especially to the importers, the exporters?
Well, of course, the issue is an exchange rate issue, because if I'm an importer, it means I'm paying in dollars. I'm using more shillings to buy the dollar. For the importer, for the exporter, you're getting dollars, so you're getting more shillings when you get paid. So again, it's a zero-sum game. If the importers are gaining, the exporters are losing. If the exporters are losing, but that's really depending on which direction the shilling is taking.
Fantastic. Well, we want to take a look at another exciting segment which we always have here, and that is Buckets 101 for this week. Well, it's now time for my favorite segment, and that is Question on the Street. Let's take a look at this week's question. We have a question from Annette, who's asking on Twitter, what is a share swap?
Thanks, Annette, for the question. A share swap is a way, especially in a merger or an acquisition, for the example, the company acquiring another one, to use shares as payment rather than to use cash. So in a share swap, they will look at the difference in the balance sheets of the two companies and then come up with a ratio of how they're going to swap the shares. For example, in KCB NBK acquisition, the balance sheet of KCB is 714 billion and NBK's balance sheet is 114 billion. So the share swap ratio is now 1 share of KCB for every 10 of NBK. So that creates a share swap. Instead of any money changing hands, they just swap the shares.
Interesting. So I can actually have a share swap with you in case I want to buy you out.
Yeah, it would be like one of mine for like 100 of yours, I guess.
Or vice versa.
Or vice versa, you're sure?
All right. Well, that is Sam Gishwe from NIC Securities, just giving us some interesting perspectives on that particular question for today. Well, we now want to take a look at what we have on a historical fact for this week. Well, that brings us to the end of this week's Trading Bell. Well, a lot to expect in the coming week as we wrap up this particular week. Well, you can always engage with us on our social media platforms, as you can see at the bottom end of your screen. You can tweet me at Agina Abi, and we'll be able to sample your views in our next show. From the entire team, and of course, Sam, thanks for your time.
Thanks for having me.
All right. And keep it locked on KTN News, where you only get the whole story. For us, it is bye-bye. I remember you telling me that there's a share I must buy. Which one was that?
Yeah.